Now let's get back to our interest rates. What does a prime lending rate of 10.5% mean if you're a homeowner? Let's take a look at some of the numbers for you. Now, if you own a home worth about R500,000, paid off for over 20 years, you're looking at an increase of about R85 a month. That doesn't sound hugely significant, but it comes after a recent rate hike as well, more expected this year. On a house of R1,000,000, you were paying about R9,800 a month. Let's move to R1,000,000, 9,984 now. So you're edging much closer to R10,000 a month. And finally, if you own a home worth R2,000,000, your monthly installment going up and now much closer, just off R20,000 a month. And you can see the jump there is more significant. So we know that rising rates, the weakening rand, the petrol price expected to rise, all bad for consumers. Just how bad? To discuss, we're joined by Maya Fischer French, the author, and she, of course, the controller of the website Maya on Money. She joins us from our studio in Cape Town. Maya, this is a small hike, but for some people, this could be like the last straw. Do you agree?
I think that that's a very good point. You know, since 2014, we've now had a 200 basis point hike if you actually look at the full cycle. So maybe those little increments of 100 or 200 rand a month in isolation don't look that much, but once you start building on it, it starts to become very significant. You were using that example of say R1,000,000 mortgage. Now, that increase over the last 2 years actually represents a 20% increase in your repayments. And considering that for most people, their biggest expense is their mortgage and their car finance as a percentage of their budget, probably around 40%, in some cases 50%. That's going to have a really, really significant impact over the last 2 years. And certainly their salary increases haven't been keeping up with that. So that squeeze is going to be felt, that extra R100, extra R200 is going to be felt. And especially, Francis, next month, of course, we have the electricity hike of 9.4% kicking in. We have the fuel levy will be coming in as well. So everything is just going to get that little bit more expensive. And again, these are items that you can't get away from. It's not like saying, you know what, I'm going to buy more beans and less meat, or I'm going to buy one less pair of shoes, or I'm going to go out a little bit less. It's not those items that we can really control. You have to pay your mortgage, you have to pay your car finance, you have to pay your electricity bills, and you have to fill up your car with petrol. And that's the problem. There isn't really anywhere to move as these rates are increasing.
Do you have any advice? Because as you allude to, it's going to be much harder to get out of debt, especially if you're already at that edge where you can't afford the luxuries anyway.
I think, you know, unfortunately, the message that I think everyone has been sending out for the last 2 years is we are in an interest rate increase cycle. If you have debts, you have to be focusing on them. You know, and I think, unfortunately, if people are now sitting with debts that they're just not coping with, they do need to start speaking to their banks. I think FNB today I saw sent out an announcement saying, please come to us, we can rearrange your credit card repayments, we can help you look at things. So I think the sooner that people take action, if they're reaching a point where they really can't afford it, and I don't mean things like, you know, you haven't really stress tested your budget yet, there are places that you can cut back on still, lifestyle choices that you can make. If you still have room for those, obviously those need to stop moving. But if you've already done all of that and you just can absorb no more of these rate increases, it's really time to start becoming very proactive, speaking to your bank and seeing if you can restructure your repayments over a longer period of time. Obviously, that does, over time, cost you more interest because interest is unfortunately still has to be paid, but it may give you a little bit of breathing space on a month-to-month basis. I would say that would be a very important step to be taking. And also, sit down as a family and start actually having these conversations. Don't just sort of hope for the best. The rates are more than likely going to increase rather than come down from here, so it's not going to get any better.
What if you're okay? Is this a time to be cautious when taking on debt, I suppose, or even when buying a home?
Absolutely. In fact, I think what you'd want to be doing now, especially if you are buying a home, for example, is to almost look at your mortgage repayments and add, I would say, another 10% onto them. Just to say, right, if I can afford to say my mortgage repayment is 5,000 Rand a month. If I can afford 5,500, then I should only really go for a mortgage of 5,000, just to be able to give yourself a little bit of leeway and then actually pay that extra 500 Rand in a month, because that really gives you a buffer against future interest rate hikes. You know that you can absorb another, sort of maybe if we're going to see another 100 basis points over the rest of the year, you know you can absorb that. You're not going to be worrying about whether or not you can keep up with those payments. So I would certainly say people should maybe look at taking out a mortgage slightly less than they could afford at the moment, and with the understanding that those repayments could possibly increase over the shorter term. And of course, the great benefit of doing that is you are paying off your mortgage quicker. So you may be you'll be paying it off over 17 years instead of 20. That's a really, really great strategy. And the same applies for car financing. You know, try and finance the car over a shorter period of time, or just buy a model down. I think we need to be sober about taking on debt at this stage.
I think I need to ask you, because you do have this option of the fixed interest rate, but is it ever a good idea, or are you penalised, especially when the banks know that rates are going to increase?
You know, Francis, I think it was a couple of years ago, there was this perfect opportunity to fix your rates. In fact, I remember writing an article about it where I remember Standard Bank specifically was offering a fixed rate at prime. And I said, wow, okay, this is an opportunity to take it. But other than that, generally speaking, the banks have already factored in future rate increases. So I don't know what the figures are at the moment. You can check with the banks. They change basically every day. But a fixed rate, you're probably looking at a good 1.5% to 2% above where you are now. And considering that it's taken nearly 2 years for us to increase by 200 basis points, and you're going to, from today, be paying another 150 or 200 basis points on your fixed rate, does that make that much sense? It makes a lot more sense for you to rather start paying an extra. So work out, okay, if I took that fixed rate, what would I be paying every month? And start paying that anyway on your flexible rate, and then obviously the variable rate, and then obviously you'll be able to absorb as the rates increase. That would be what I would be doing. I would be completely wrong if we go up by another sort of 500 basis points from here, but I don't know how likely that is at this stage.
All right, so some good advice. Maya, you look at the numbers, you also watch the Rand and the big macroeconomic issues. Are you feeling a bit frustrated? Do you think South Africans are feeling frustrated that so much is going on? The US Fed, politics here at home, the Rand weakening, so much out of our control, and I guess there's nothing we can do about that.
You know, I saw a comment today. Somebody said the Reserve Bank could probably have snuck in 100 basis points and no one would have noticed because of everything that's going on around us. So I think that is it. I think there is an element of just frustration. We understand why our currency is weakening, but there's nothing we can do about it. We understand that a weaker currency is going to lead to higher inflation. We're frustrated by the fact that job growth isn't coming through. You know, it's all good and well. Currency weakens, but if people have jobs, if people's salaries are increasing, you can absorb it. But we're looking at very low growth rates. If we move into a recession, it can become even worse. We're facing a drought. So I think there must be a level of despondency within most households at this stage. And I think we know, but we must maybe try and, you know, not get too depressed about it at the moment. But definitely, I think we're looking around us at events, and especially what's happened over the last few days, and just wondering, you know, how, you know, what about the man on the street? What about households? What about people who are just trying to get their kids through school and at university, and just trying to make the best of their lives? I think it is a very challenging environment.
All right, thank you very much. Maya Fischer French from Maya on Money. Well, that Rand, you may not have noticed either, did strengthen a little bit after that decision by the Reserve Bank. Let's